we have Kyle Adkins here from FullCycle Climate Partners, and he works on the commercialization and deployment of climate critical technologies, helping with companies, just so somebody walked past up there, and helping transform the global economy. So we are so pleased to have him here with us today. Please welcome Kyle to the Friday Coffee Meetup stage.
Thanks, Christy. Well, it's great to be here this morning and talk a little bit about this. I'll try to keep this as fast-paced and moving as possible. And of course, we'll have some Q&A afterwards, but if there's any burning questions, please feel free to raise your hand and bring it. I think the big thing that really prompted what I'm here to talk about today is that I feel like, especially when we even broader beyond climate, but there's been a very negative techno-dystopian kind of view of the world today. And everything that I'm doing, what I'm seeing around us is nothing but cause for optimism, ultimately. There's a lot of problems to work through. There's a lot of things that we have to reconcile with. But ultimately, we are on the cusp of what I like to call building an abundant future. And that's really what I wanted to show here today. And I like to set the stage a little bit in, back in, we were just talking about the days of the pandemic, back in April of 2020, Mark Andreessen penned this big thing, it's time to build, huzzah, and everyone was like, this is great. And then he spent the next 2 years deploying billions of dollars into crypto. So nothing to say against crypto, but didn't exactly kind of back up what he said with this whole thing. But the sentiment was very much there that we are at a point where it's not just about investing in bits, we need to actually invest in atoms. And this is someone who, prior to focusing just on climate tech, I've invested across the ecosystem. In fact, plenty of software companies, plenty of hardware companies. And everyone kind of forgets with all these great software companies, the billions of dollars that Amazon and Microsoft and Google have been deploying into the infrastructure behind that's powered that, enable that ecosystem. And we are at the phases now where we need to build out that next layer of infrastructure in our industrial base and in our broader economy that's much more beyond what the focus historically has been. This does not have to be our reality. And this is what I feel like is so much dominating the narrative today. And this is what I wanted to talk about a little bit about the pathways that are in place today and what I'm seeing that causes optimism for us and what we are doing, and that hopefully can translate to the broader economy. Full acknowledgement, progress has been made, but there still is a long hill to climb ultimately. We are a long ways to go to get to where we need to be from a climate perspective. But there is a lot that we can do about it. There are a lot of levers that people are starting to recognize. It's not just about CO2. It's about, there's a number of other greenhouse gases. There's methane, there's nitrous oxide, there's fluorinated gases. Everyone remember the ozone layer and the ozone hole. There's a lot that we can do out there that can really bend the needle ultimately at the end of the day if we get smarter about how we are going about doing this. And that's a part of what I want to talk about as a precursor to this. Because ultimately, we could literally shut off all CO2 emissions tomorrow, and ultimately our warming trajectory will slow, but it will not actually retreat. That's why there's been such a discussion around removing carbon from the atmosphere, because ultimately that's how you bend the curve if you do nothing but CO2. You shut off all methane emissions tomorrow and you can actually reverse the warming trajectory of the planet as it sits today. And that's really what I'm getting at here, is that we have the levers and we have the tools in place, especially when you pair that with that 1% of emissions, which is methane, nitrous oxide, fluorinated gas, in other words, is 46% of global warming potential. And so the levers are in place to really actually make a difference here. If you think about it from a molecule basis and then overlay that with the technology that's available today. And ultimately, where this starts with is that we are having this massive learning curve that is translating to real dollars and cents. Solar, wind, all these technologies have gotten cheaper than the legacy alternatives. And this is the bleeding edge of the curve, right? You see solar going up everywhere now. Everyone knows that solar works, and it's just a question of cost and price ultimately. But at the end of the day, solar alone is not enough. This is just a precursor to everything that needs to come behind that. But it's a great roadmap for what we see going forward. And you can translate here. we're seeing it in the economy. We're seeing these green shoots that are much broader than what we have today. Talking about the pandemic earlier, it caused this real rejiggering of supply chains, how we think about our industrial base, our industrial capacity, where is that located, how are we tapping into that? And you can see this here where there's a real shift around onshoring, nearshoring, reshoring of industrial capacity from an offshoring model that has been so predominant over the last 20 years. We can get into a whole conversation around that. But the matter is that it's time to build, and we're building here in the US, in the EU, elsewhere, alongside of everywhere. It's a global build out that needs to occur ultimately at the end of the day. It's a massive market. When we talk about climate, the way that we define this, we think of this as a $42 trillion addressable market. It's basically the most the economy is at play in different sort of ways. You've got, of course, energy in the top left, but you've got industry, transport, agriculture, waste, buildings, all these major areas that are all going to ultimately, end of the day, lead into what we're talking about here today. So much of the conversation, I feel like, with climate has been around the good and what we can do from an impact perspective. And we're a climate impact fund. But ultimately, at the end of the day, the biggest point that we make clear to folks is that these technologies are not being deployed because they make you feel good about yourself, because they're better for the world, because they're better for, warming, whatever it might be. They're being deployed because they are better than the legacy alternative. They are fundamentally outcompeting our legacy oil and gas-based footprints, and we are on the early edges of a major next wave of industrial transformation. And that, I think, is the fundamental point that gets lost a lot of times in this conversation, is that so much has been around subsidies and carbon monetization and all these sorts of things. We have this great IRA bill, which is, putting fuel on the fire. But ultimately, at the end of the day, there are massive swaths of technology that are ready to go today. I think this is a really important point to point out. So 25% of mature climate technologies are in kind of that reducing costs and unlocking an upstream ecosystem. They're being deployed. This is your solar, wind, batteries, EV storage, things like that. 40% of the technology has been developed. We have it ready today, but it hasn't been widely commercially deployed yet. Only 35% of the technology that's needed to get to a net zero economy is yet to be developed yet. And we're seeing great innovation there as well, and that's a fantastic piece of it. But massive piece is already ready to go. We keep doing what we're doing on that 25%, and we unlock this 40%. We're obviously getting a long ways away. And so much of this makes it seem like it's futuristic. There's talk about fusion, things like that. It's 20, 30 years off. We have most of the technology we need today to build the world that we want to see going forward. And it's being backed up by the talent. There's been a massive flow of talent into climate. People see this opportunity. We saw this before. I grew up in the Bay Area. We saw this massive wave into Silicon Valley, building out what we know that as today. We're seeing the same thing happening in climate tech. All these people who have been working on bits, as we were talking about earlier, are shifting to atoms. You can see it here locally in Pasadena. You can see it in El Segundo. You can see it other places in this area. There's a massive shift in our worker base that is working on the things that are going to matter for the next 20 or 30 years. And that's not to knock software. Software is going to be a big, important piece of this overall ecosystem. But if software has nothing to interact with, it doesn't matter. You can't operate in a vacuum. If you want to have an impact on the physical world, you actually have to build the tools to interface with the physical world. That's where the infrastructure comes into play. But climate infrastructure historically is very slow to mature. Solar and wind took decades to reach market maturity. It was commercially ready from a technology perspective back in the 70s. But because of the lack of investment for a very long time, until the last couple decades, it took a very long time to get down the cost parity curve. We don't have time to wait. We don't have 30 or 40 years for the next technologies that are at the solar and wind of the 70s to get to where solar and wind is at today. They have to be done in the next 5 to 10 years instead. And that's really the imperative that we have to focus on as a global economy. And it's not quite happening today. It's getting there. But if you look at $331 billion over the last 7-8 years have been deployed into climate tech, in early stage venture, mid stage venture, late stage venture. 57% of it has gone into transport. That's mainly electric vehicles, autonomous vehicles, all that sort of stuff. That's great. We need that. But transport's only 13% of global greenhouse gas emissions. There is a huge piece of the overall stack that's not receiving nearly enough capital relative to the scale of the opportunity that's at play. And that's nothing to say that $331 billion is still a drop in the bucket relative to the overall amount of capital that we should be deploying into this opportunity. But ultimately, it's about this piece here. This is where we come into play with FullCycle. There's been lots of innovation, lots of capital being deployed at the earliest stages. You see a new climate tech fund being raised every other day. Inevitably, what are they focused on? Pre-seed, seed, Series A. And then you see lots and lots of infrastructure and private equity funds being raised downstream, multi-billion-dollar funds. That's great. We need that capital in the ecosystem, but they're way over here. They are solar at infrastructure scale has been bid down to low single-digit returns in a lot of cases. We're talking 3%, 4%, 5% yielding projects. That's not viable. And that's because there's a supply-demand imbalance. There's so much capital that's looking for sustainable projects at scale that have not gotten there yet. We need this. This is the big issue today. There's plenty of tech that's been innovated. We need to figure out how we get from there to here. And we need to do it in 5 to 10 years, we said. And that's really what we're talking about here. Because ultimately, from an investment opportunity, like I said, it's a $42 trillion global market opportunity. It's a recession-resilient asset class. Even in the last, 18 months, when things have really fallen off the cliff in the broader economy from a market's perspective, the job numbers today are still strong. We've got this weird imbalance between market and economy. But climate has not shown the same thing. It continues to go up and to the right. And that's because there's such fundamental tailwinds at play that are driving what we're working on today. And it comes around, it's energy, it's supply chain security. We've seen the weaponization from the Ukraine war that is causing everyone to rethink our industrial base, our industrial capacity, and how we think about overall supply chains. You guys talk about fashion in the back. A lot of that over the last 20, 30 years, we had a major textile industry here in the US. A lot of that got offshored to Southeast Asia. A lot of that had to do with it was dirty, polluting processes that we were offshoring to someone else's problem. Well, do you know what? At the end of the day, it's not someone else's problem because we're a global society, ultimately, at the end of the day. What we are seeing is that if you want to build a circular textile economy, you got to move that capacity back to where the waste is being generated. So it's not just one region, it should be in all regions, ultimately, at the end of the day. And that's really, I went through a bunch there because I really wanted to just kind of lay it all out there and share plenty of time for Q&A ultimately, because there's a lot to unpack here. So with that, I'm happy to get into any more detail on that, but I just wanted to lay out, this is kind of the imperative that we see today. But there is the roadmap in place to getting to that abundant future. This is not about doomerism and dystopia. We really are on the cusp of a bigger, brighter future. And this is just in climate. I can get into other pieces of the technology ecosystem as well. But with that, I'll take pause for questions and all that sort of stuff. And thank you for the work for the presentation.
Awesome. Thank you, Kyle. I love the abundant future spin on this. Big fan of that. We are going to do Q&A. Make sure your sentences are short and have a question mark at the end. Kyle will stick around after for stories or other comments that you have. And our good ex-co-organizer friend, Alex Miller, is going to come and do Q&A. I'm going to get you the other mic.
All right.
Yeah. Alex, as you're getting started, can you tell your experience in this area as well?
Sure. So yeah, I'm former co-organizer with Christy. Right-hand side of the crowd starts on private equity, invest in more solar, wind, and batteries because they're scalable. So let's get some questions. All right.
Hi, I work in infrastructure development, so building like big compost facilities, wastewater, organic residual facilities. So one of the things that I've seen in the market is a couple of things. One, to your point, we already have the technology, but we don't have the mindset on how to deploy this. So I wanted to get your take on, number one, I think there's a real misunderstanding of economies of scale in this industry. And so this idea to only build super big facilities, I think has a big flaw in it.
Yeah.
Number one. And number two, so I want your take on that. And number two, what we're running into in the field is that private equity, especially here in California, doesn't want to invest in greenfield anymore. They want to buy distressed assets. So I want your take on that.
Yeah, no, absolutely. There's a lot on. I'm not sure if this is it okay. So there's just a lot to unpack with that question. But I think first and foremost, we see the same thing when it comes to the scalability. There are certain technologies that will get to traditional infrastructure industrial scale on individual projects, but also we see there's a lot of opportunities where you have to take more of a distributed approach, where the overall capacity is going to scale in the same sort of way, but each of those individual facilities will be smaller in orders of magnitude relative to what you might have. And so really, I think from our perspective, we've got portfolio companies that are going to be building refinery scale infrastructure when they get to that point. And we've got companies that will never get to that point because all they're going to be doing is smaller installations, but it'll be rinse and repeating on a large scale that way. So I think having more of a nimble mentality around that, we're seeing the ecosystem starting to get around to that. But I do think that there still is a big gap in the marketplace today around that thinking. Because, on the one hand, you've got, industrial sales, solar, where a lot of infrastructure firms have spent their time on. But then as you get further down, like in solar, for example, I was talking to a firm yesterday that's focused on very small scale community solar deployments. And some of those will never get to that scale and they'll never be attractive for that pool of capital. That doesn't mean that there aren't pools of capital that can hit all these different pieces of the ecosystem. And so I think that's a part of like what we see broadly, is that there has to be a broader approach in terms of how capital is deployed broadly in the ecosystem, that your large scale infrastructure funds play a big vital role in this, but that we need other pieces of capital playing in this ecosystem as well. And all of them have their role to play ultimately at the end of the day. And so I think that's the first one. Then the second one, when it comes to greenfield and all that, we definitely see the same sort of issues at play. And that is a whole talk in and of itself. There is regulatory hurdles, there's interconnect issues, there's all kinds, depending on what technology you're talking about. And I think that was probably one of the most unfortunate pieces of the Inflation Reduction Act, was that it was supposed to be paired with a overhaul of our regulatory infrastructure that never happened. And so now we have got billions and billions of dollars of solar and wind projects and storage and renewables and all that are sitting in a 10-year queue of interconnect to get to where they need to go. That's not going to help anyone at the end of the day. And so ultimately, I think what we have to think about, and I feel like there's this real push and pull where you have more of a historic environmentalist approach that's been about build nothing. It's not building. It's not that any kind of building is bad. And ultimately, we need to bring that arm back with the techno side of the house to work together, because, we're going to have to build out transmission infrastructure. We're going to have to build out deployments of new physical infrastructure. There's going to be puts and takes around that. But if ultimately it still is moving us in the right direction, we have to wrap our arms around that. But I think there's a big issue around that. And I think a lot of the distress plays and other sorts of things that you're seeing in there, a lot of that has to come down to is there's a lot of permitting regulatory hurdles that are already checked on those assets that you don't have to clear with a greenfield that's driving that. But obviously that's not always the most productive if you've got legacy assets that you have to turn over. So we see the same thing very much so.
Okay, good questions from the audience. Okay.
Hi, thanks for coming. My name is Leah Pillsbury and I work for a company that does hydrogen infrastructure, and we're actually based out of Boston at Greentown Labs. And my impression of having moved to California during the pandemic is there's a lot of excitement about environmental projects and a lot of big projects and a ton of money, some cool regulations, and I haven't seen as much of the tech. And so I'm really interested to hear about what's going on here in Pasadena and elsewhere. You mentioned El Segundo, I think, of like new companies that you're seeing and what you see people thinking about here.
Yeah, so I mean, on a local base, those are a couple particular hubs that we've seen here in Pasadena, just with JPL and Caltech and all that. You have a lot of innovation spinning out that, there's a lot of great engineers and scientists here locally. El Segundo, with its historical aerospace and defense infrastructures, there's a huge lot of innovation happening there, obviously with SpaceX and all that sort of stuff, but also that's translating to engineering skill sets that are translatable to climate tech and other sorts of more atoms versus bits sort of stuff as well. So, I mean, if I think back to the last 2 years, we have seen about 1,000 companies come through our door that are all generally, for the most part, pretty early stage sort of stuff. And that's not to say that all of them are going to be home runs out of the park, but I think what we're seeing is that unlike in the last 20 or 30 years, where a lot of the innovation in tech broadly was very concentrated, it was Silicon Valley, it was Boston, it was New York. We're seeing much more broad-based. So we're seeing the innovation all over the US, all over the EU, all over the world broadly, and it's much more distributed. There's great hubs of innovation because ultimately at the end of the day, when you think about climate tech and sustainability, it's a much broader lens of the economy. So there's great research institutions that are very focused on very specific pieces. Tell you like CU Boulder has got some very interesting stuff around algae and other sorts of things and it's just, I can go down like all these regional hubs where we're seeing really interesting innovation at play. But what's happening right now is that a lot of the early stage capital that has been raised, a lot of it is more what I call like Silicon Valley adjacent sort of approaches. So we're seeing a lot of, companies that are like, investment firms are like, I'm investing in climate, but I'm investing in, software for climate or things like that. Where that's the stuff that they know, and that's fine. That's great. Like we need that piece of the ecosystem as well, but not nearly enough even at the early stages is going to more fundamental hard tech sort of innovation. But it's changing. We're seeing a lot more capital is getting raised on that, but those take a long time. Those innovations take 15 to 20 years to get to where we need them to be because they're, it's science that we're starting with in a lot of those cases. But we're seeing a lot of interesting things where people are figuring out how to turn things into commercialization steps faster than what they used to be. A lot of our companies that we're seeing have been around for 8, 10, 12, 15 years before they get to the commercialization step that when they're ready for what we do. But what we have seen over the last 5 years is there's a lot more less than 5-year-old companies that are figuring out how to get there faster. So we're seeing this interesting confluence. We're seeing the 15-year-old companies and the 5-year-old companies that are at the same point, but with great technology on both cases. Whereas historically, you saw a 15-year-old company, you think that's 15-year-old technology. In some cases, that still is very much the case. But in a lot of cases, it took that long to get to the point where they're at today.
So yeah, thanks for the talk. That was insightful. As you talk about atoms versus bits, I like that. But from an investment perspective, and I'm familiar with the bits, much more so than the atoms. Although I've tinkered with technology, not necessarily environment tech, but I've built things. Things seem to take a lot longer to build. They're more expensive. They're a lot slower to iterate, a lot slower to deploy and to scale. And so because of that, what do the investments look like from your perspective? Do they end up being significantly larger, or do you feel like they're riskier? How does that look like?
Yeah.
Question, sorry.
I think one of the biggest differences that I see is if you think about scaling a SaaS software company, it's very incremental. Like, everyone talks about 1 million of ARR, 5 million of ARR, 10 million of ARR, annual recurring revenue. And there's these, hurdle points that people are focused on. And the way that you get there is you're generally selling 50 to 500K annual recurring revenue contracts to your customers. And so you can see this, there's a lot of metrics that are behind that. You can see this smooth curve going up as you're building and scaling. Whereas like in more of the Atom sort of stuff, it takes a lot of capital, but like, we've got companies that are going to go from effectively pre-revenue or minimal revenue to 40 million of revenue next year because they're building their first facility right now that's got the capacity, it's got the revenue it's got the offtake contracts, everything that you need. So it's more lumpy and it's more stepwise sort of changes, which is really hard for those that are more conditioned to scaling software companies. And a lot of those folks forget about on-prem and what that revenue model looked like way back in the day, which is much more lumpier and closer to what Atoms look like today. And so I think that's what is causing people to have to like rethink, is that it takes a lot of capital. It certainly takes a lot longer, but you basically can do much lumpier, big jumps in the revenue scale. Where, I mean, I can't say I've ever invested in a software company that went 0 to 40 million of revenue in a year. And so that I think is the difference, is that there's a lot of more incremental steps that aren't necessarily geared off of revenue. Whereas I think a lot of the ecosystem has been generally geared towards revenue being a sign of commercial progress, which isn't necessarily all. There's a lot of other things that you can look at to know that you're building and putting all the different pieces that you need to go from that 0 to 40 or 0 to 20 or whatever it is that the company is doing.
Yeah. Thanks. You packed a lot into your presentation. There's a lot to digest. I'd be interested in your portfolio companies, if you could highlight some of them and what they're doing. And I'm also curious to know where they are.
Sure. So we have out of this fund that's focused on what we're talking about here today, we've invested in 5 companies. 3 of them are in the US. One is Seattle, one is Portland, and one is outside of Atlanta. And then we have 1 company in Toronto and 1 company in outside of Amsterdam. So we focus on kind of North America and EU, UK for a starting point for the technology footprint. And the types of things that we're doing, so I'll give you a couple of examples. I mentioned the textile company earlier. They have developed a chemical recycling technology that can take textile waste, depolymerize it down into a pulp, as you would think about like, pulp and paper or things like that. And then that can be spun into new fiber. They have the ability to spin that fiber using 100% waste content with it, which is an industry first. And that fiber, even though it has a cellulosic backbone, actually has performance characteristics that are similar to synthetic fibers. So from a strength and tenacity perspective and a bunch of the other things that lead to polyester and some of the other ones winning out in a lot of use cases, they actually can be a drop-in replacement for that instead. And so it's really about it's a circular play. It's ultimately we're taking waste and turning it into new products, and it's not a downcycling play. It's very much going molecule to molecule, textile to textile, and preserving or increasing value in the ecosystem, which is a very big focus for us generally. Another one, I'll do the Netherlands example. It's in the circular plastic space. So there's definitely a bit of a circularity theme as one of our big elements. But they can take your traditional municipal solid waste, other sorts of forms, and they have got what I describe as a refinery-like process that can basically break down all of that waste into your chemical building blocks for making new plastics out the back end, and allows you to completely skip the cracking units in traditional petrochemical infrastructure, which is far and away the largest single source of greenhouse gas emissions in the plastics ecosystem. And so that allows you to actually really, truly innovate around that. That's also a huge source of cost as well. And I think that's a really interesting thing that we have seen across the board, that in a lot of cases, greenhouse gas savings actually translate to cost savings as well. Because if you can cut out process steps that are around that, that actually can translate to cost savings as well. And that's what you can have. So like, for example, they are at 50% the cost of traditional petrochemical-based plastics, in an industry that 2 or 3% process innovation is huge. So those are a couple of examples. We have another one in Portland that is in the renewable power space, where if you think about your traditional municipal water infrastructure as an example, it takes a lot of pressure to move that water throughout, say, the Pasadena area here. And if you don't actually reduce that pressure before it runs to your home, it's going to blow out your faucet and whatnot. So there's these pressure reduction valves throughout a water district that today, typically, the way that's done is just kinetic friction that basically slows down the water and reduces pressure, and that just dissipates as waste heat. Instead, what we have is a system that can capture that kinetic energy, basically like a micro hydro turbine, that can turn that into clean baseload power because the water is always moving. And so, that can be deployed into municipal water infrastructure. They tend to be very conservative, getting to the questions around regulatory stuff earlier. There's a lot of other processes in industrial landscapes, agriculture, and other ones where you have that same movement of fluid that requires pressure step downs that you can tap into ultimately as well. So these are really some of the different pieces of the ecosystem that we're looking at. But to us, solar, wind, storage is a huge element. There's a lot of capital going to that, but there's this massive tail that we need to be investing in as well. And that's really our focus. So it's not to say that we shouldn't be doing that stuff. It's to say we need to do that and all of these other pieces as well.
Hi, everyone. Darren Higa, finance and a data guy. So really amazing presentation. I loved all the infographic stuff. Question for you is, can you tell us a little more about your background? And you're obviously extremely passionate about this stuff. And I'm curious, how did you get into climate tech investing? Did you start off in a more traditional, like investment banking at Goldman, or like any of those kind of roles before you kind of moved over? Or have you always been a climate tech person?
Both. So getting to the atoms versus bits, I studied both as an undergrad. I was EE and CS. So I have an engineering background, but then went to JP Morgan. I did tech banking for a couple years and then moved over to the buy side to a big private equity fund up in San Francisco called Golden Gate Capital that is more late stage private equity buyouts, but two of their big verticals was tech and industrials. And I would say that throughout my career prior to dedicating solely into climate, it's been focused on tech and industrials. I went to another more lower mid-market private equity fund that was tech and industrials. And then I worked to a growth equity. So I've kind of been moving earlier and earlier as you go along as well. It's all been tech and industrials. And so ultimately what got me bullish on climate was I was doing tech and industrials for a very long time and was seeing some of these pain points, seeing some of these problems, was getting very bullish on the investment opportunity that was at hand here, and deciding to want to dedicate the next step in my career to solely being focused on this because I view it as just, it's the biggest investment opportunity out there right now, in my opinion.
Hi, Henry Matheson with Chorus Capital Partners. I'm one of the evil investment bankers. We focus on just helping private companies raise capital from the private market. Just curious on if you can share some of the preferred criteria that you guys look for in terms of a company's metrics and where they are in their life cycle, and also curious how you're seeing the definition of today's Series B, C, D. What does that even mean today?
Yes. So we're focused on Series B plus or minus. Some of those Series Bs look more like Series A's or Series C's, depending on what we have. The letters mean less than it used to be anymore. But really the things that we're looking for is we are looking for companies that have demonstrable data around their technology that has shown that they've taken it from lab bench scale to some small pilot demonstration, and that we can draw a through line to their first commercial scale deployment, whatever that might look like. That it's not Herculean assumptions around scale ups, other sorts of things like that, that give you a lot of confidence that the technology will continue to scale. And then we bring in a lot of experts behind that, in addition to what we have, to prove and validate and really hammer those technologies. And a few of the things that we see over and over again is that big pieces of the ultimate commercial deployments of the technology are leveraging very well proven off the shelf equipment. Maybe it's a slightly novel use in terms of how things are getting arranged, or maybe the equipment is in the same, but it's a chemistry in it. It's a chemical innovation instead, or whatever it might be ultimately that gives you a lot of confidence that big fundamental pieces can work. So like with the circular plastics company, for example, most of the equipment is actually traditional refinery equipment that we know have scaled to substantially orders larger of magnitude than where they're at today. The textile company, pulp and paper equipment, the mixers, your stands, your pumps, all that sort of stuff. We're basically buying equipment from the pulp and paper industry for that. And so that gives you a lot of confidence that big fundamental pieces are going to work and are going to scale. And that allows you to focus your efforts on that real 10% of innovation that unlocks all the difference ultimately. So those are really kind of things from a technology perspective that we look for. But then the other two large, well, there's really three big other elements for some of the infrastructure folks in the room. They'd recognize this is that you need to have feedstock, you need to have offtake, you need to have site control, regulatory, there's a bunch of other things. But ultimately what that boils down to is that you typically are not going to have a traditional 20-year offtake arrangement. So you got to have confidence that there's the commercial demand, at least for enough years or enough time period that will give you the confidence to go build, and then you'll have revenue to backfill and support, the infrastructure that you're investing in there. Sometimes that might look like smaller contracts. Sometimes you can get those 5, 10, 15-year contracts. So it depends also on the end market. Like textiles, for example, you'll never get a 20-year offtake agreement. They're buying typically a 3 to 5 year lots at most. And that's just something that if you want to play in textiles, you got to get comfortable with those dynamics. It looks a little bit more like a manufacturing play as opposed to more of like a, an energy, oil and gas sort of infrastructure play. So you have to kind of, have the innovation around that. But feedstock is also a huge piece of this as well. What are the inputs that you need to turn into the output that you're ultimately trying to solve for? And sometimes access and availability to the feedstock is almost more challenging than the offtake out the back end in the actual process. So seeing that there is that recipe, that ultimately translates to the site, because you need to be able to locate your site in places where you can either get access to the feedstock and can, deliver the offtake in whatever form it needs to deliver it. So if you're making renewable natural gas, having a pipeline nearby or a facility that's, taking it themselves, having those sorts of pieces in place. We talked about interconnect earlier. When you're talking about energy, that micro hydro turbine I talked about, we have one stuck in interconnect hell up in the Bay Area right now. And so we're trying to figure out, is there something we can hook onto it behind the meter and not have to worry about that instead? So people get, they figure out the ways to generate revenue. And I think that's really, what we're going to have to think about broadly as an economy. There's, all these solar projects. We're looking at them right now. We're talking to them about, can we deploy something? We'll tap into your solar and you can forget about the interconnects, for example. Because just waiting on the government, unfortunately, is not going to get it done on its own. We have, private industry has to innovate around this. The IRA bill is fantastic. It's a great starting point. It's a real shot in the arm to the innovation ecosystem behind that. But ultimately, that's not going to get it done. We need so much more of that. We need private industry to really step in a big way. And it is. It's just takes time.
All right, time for one more question. You commented earlier that the return on investment in solar and wind wasn't very good. Is that still true in less developed countries than the US? And are there people trying to address that?
It's all about risk reward. So if you want to invest in a large industrial scale solar project here in the US, it's a lot less risk, but then that translates to, there's going to be a bid down on your cost of capital to deploy those. If you're doing something in sub-Saharan Africa, there's a lot higher risk around the build out of that project, and therefore would necessitate higher returns. And so that's not a global phenomena. It's more of it's just a fundamental finance risk reward sort of profile. So for example, a lot of our technology, we think of it as we're looking for 6 continent solutions, but we're starting in the developed regions where we can prove the technology out because it's a much easier road to get to deploying and proving it out, and then taking on some of the more riskier development around deploying it to other parts of the world, like sub-Saharan Africa, Latin America, South America, places like that, that frankly, we'll work with partners like the IFC, World Bank, and others who have been doing that for decades and have the on-the-ground contacts and other sorts of things that we can take our technology and deploy it into those regions. But it would be the higher reward profile because there's going to be higher risk behind those. Hopefully the risk goes down over time, but that's where we're at today.